Hello, in this video we are going to look at the concept of CDS, which is a credit default swap, and it is one of the things that led to the economic crash of '07 and '08. So a credit default swap is essentially a method of ensuring an investment, you can say. So let's do an example. Let's say if we have company A here and we have company B over here, and let's say if company A wants to invest in company B, and this could be in the context of some sort of fund investing for a pension system, or it could just be a company in general, your own company investing, whatever it is. And let's say they want to invest £1 million in company B, but company B is double C rated, and you'll have some sort of rating agency in America. It is an organization called Moody's, and that would give a company a rating. The higher the rating, it just means the better they are at paying you back, the more likely they're going to pay you back. So in this example, the idea is that company A gives company B £1 million, and in return they would give, let's say, company A back 10% return per year, which equates to £100,000. And let's say the idea is after 5 years, so the loan will mature after 5 years, so company B will have to pay back company A the £1 million. Okay, so the issue is, because company B is pretty low rated, let's say if it was AA, that'd be great, and maybe company A only wants to invest in highly rated companies, then this will be out of the question, because if after 2 years they can't pay back, or at the end of the 5 years they say we can't pay you back, we're going bust, you've lost your money. Obviously you've got some return. In this case you would have had 50% return if you went to the full 5 years, but again they won't be able to pay back the principal. This is where the idea of a credit default swap comes in. So another organization, so let's call this number C, kind of like an insurance company. I'll explain to you in a second why I'm saying it's kind of like an insurance company. Number C, and let's say this is rated to AA standards. They say we will protect company A's investment. They will protect the investment on the condition that of the £100,000 or the 10% that is given back as interest to company A, they get, let's say, 2 of that 10%, so they get a 20th of it. So 80,000 goes to company A and 20,000 goes to company C, which is the insurance company. And the insurance company is saying, as long as we get that every year, if company B was to fold and say they cannot pay back the loan, that company C, in that hopefully rare scenario, that's what they're hoping for, is a rare scenario, would pay back the full £1 million. So that looks great. Company A takes a little less money in terms of interest. They're protected by company B because they are insured via a credit default swap from company C, which is AA rated. A rating agency, if there's one involved, or their own internal rating system is satisfied, everything's good. Sounds all good. So let me circle back to when I said it's kind of like an insurance company. An insurance company, generally speaking, will have to have the amount of money that it's insuring against, or some portion of it, on hand in cash. So if some of the companies were to fold or something was to happen, they would have that money to pay back. Organizations that do credit default swaps, or that were doing them in '07, '08, didn't have any requirement of holding X amount of money. They didn't have to. They could hold all of it, or they could hold theoretically zero. So that's the problem. If they're doing 1 or 2 investments, that's fine. But what if they're doing, let me undo that, 1,000 investments like that, or I'll put 10,000, 1,000 investments. If of those 1,000, 2 fold, that's not a problem. They probably can easily, pay that back. But what if all of a sudden some sort of snowball effect happens, like what happened with the economy, and you go from 2 to 5 to 10 to 100 to maybe even 500? This organization that is doing these credit default swaps and essentially ensuring the investment won't have the money to be able to pay all these loans back because they're all defaulting. And that means company A is out of luck. Company C will probably end up folding because there's that much pressure on them to pay all these loans, not back, but to protect them, and they can't. And as a result, all the other potential loans that they've secured will also go down. So I would argue, is this even AA rated? Because if it's investing or if it's securing investments that are CC, DD, or really low rating and not holding that much money themselves, I would say it's probably not AA rated. It's probably a lot lower. It's probably in between an average. So that's what a credit default swap is. It's when a company wants to invest in another company, and it's probably not the best investment, but maybe the return's very good as a result of that, as a result of it being a bit risky, and a third-party organization secures the investment through a credit default swap, assuring company A that if anything was to happen, they will protect the investment. And that's the concept. Didn't work out in 07-08. There was a huge problem with it. I'll be covering the 07-08 crisis in more depth. Obviously, this is just a general economic concept which is applied to 07-08, but I'll do videos directly related to what specifically happened. So that's it. If you have any questions, feel free to join the Discord group. Over 4,400 members on there now. There's a link in the description, and there's a bunch of finance channels. Look forward to seeing you in the next video.